Let's understand what is this risk adjusted discount rate. In business, we have to take a lot of risk, right? Because only when you take risk you will be able to earn a reasonable return. But the point is, what should be your return when you take more risk? If your risk is more, should your return also be more? Yes, obviously. And when your risk is very less, then you can also expect a less return. So if you take more risk, you would like to earn more return. So it means the projects which carries a high risk, okay, should give high return. So how do we evaluate the projects generally? Generally, we evaluate the project by finding their present value of cash flows. Okay, so for finding the present value of cash flows and comparing it with the investment to take a decision, we need what is known as a discount rate, because only if you have discount rate you will be able to find the present value of cash flows. So the discount rate which is used in capital budgeting represents the expected rate of return. And this discount rate is nothing but generally it is the cost of capital of the business. So the projects which has a lower risk will have a low discount rate. The projects with a lower risk will have low discount rate, and the projects with a higher risk will have high discount rate. Okay, but the company's cost of capital will not distinguish the projects, because the cost of capital is the minimum expected return, and this cost of capital does not distinguish the project which has a low risk and high risk. So the message is, when you take a project which is going to have a low risk, then your cost of capital or your discount rate should also be adjusted downwards. And when you take up the project with the high risk, your cutoff discount rate should also be adjusted upwards. So there should be adjustment in the discount rates which you select for discounting and finding the present value of cash flows. So this is referred to as what is known as risk adjusted discount rate. So when you adjust your discount rate for the risk either on the higher side or on the lower side, then it is called as risk adjusted discount rate. So by using this risk adjusted discount rate, you have to find the NPV, that is net present value, and if the project yields positive NPV using the risk adjusted discount rate, you would select the project, otherwise you would discard the project. Okay. So the point which you have to remember is the two projects with the identical standard deviation can fall under two risk grades. So here we have to understand what is known as risk range, because we are talking about risk, right? So in what risk range you have to analyze or you have to understand the project. So what the companies would generally do is, they will formulate a schedule of risk categories. I'll write it here. They will have a schedule of risk categories. That is, risk will be categorized. Okay, so this schedule will range from their minimum discount rate. Okay, that is, it will start with from their minimum cost of capital. Okay, it will start with minimum cost of capital and it can go to the various levels. So it is customary for the companies to formulate a schedule of risk categories ranging from normal discount rate to 10 to 15% over the cutoff rate. So your, say for example, your minimum cost of capital can be 10%, and depending upon the risk, your expectation level can go up even by say 15%, and you may expect 25% return on certain projects. So this would undergo change when the risk grade increases from the cutoff group. So let me give a simple example. Let's say you are going to categorize the risk as say A, B, C, D and E. So you have 5 different categories of risk, and you just going to define the nature of risk. You say that risk A is something normal, and risk B is normal plus, and risk C is medium category, okay, and risk D is a very high risk, or say high risk, and E is very high risk. So when your project comes under these category, then you will have a risk range. Okay, you will have what is known as risk range, and you might say that when the project comes under category A, you may define the risk range as 0 to 10, and the normal plus can be coming under like 11 to 15, and this can be say something like 16 to 20, then 21 to 25, and it's greater than 25. Okay, so here when your project comes under these categories, that is say your expectation touches this range, then you would classify the projects in these categories. Okay, so accordingly your discount rate will also undergo change. When your project is only at say a risk category A, you would expect only 8%, but when it gets into category B, your expectation will go up, say 10%, and when it comes in C, you would expect 12%, and here it's going to be 15, and here it's going to be 20. So what you got to understand is, when you have a different risk range, then your expectations will also go up, so your discount rates will also go up. So this is about risk adjusted discount rate, but this concept by itself has certain limitations as well. What is the limitation? See, calculating the risk adjusted, or of understanding or following this risk adjusted discount rate is very simple, but how do you compute this risk adjusted discount rate? That involves a lot of subjectivity, and it also involves practical difficulties. What is a practical difficulty? How you are going to translate your risk in percentages. Here we have translated risk, right? How you are going to do this translation in percentages on consistent basis, and how you are going to allocate the projects into different classes. I mean, how do you decide your project comes under category A or B or C or D or E? So that's the limitation, but still it is one of the best method, so that you will be able to take a very correct decision with respect to selecting a project. Okay, so let me also give how do you compute this risk adjusted discount rate. So I'll put it here, method of computing risk adjusted discount rate. It's simple. The first step is you have to identify the cash flows. First you have to identify the cash flows. The second one, you have to compute the risk adjusted discount rate. This risk adjusted discount rate is nothing but your basic cost of capital, which is KO, plus you should have a premium for risk. So if these two are put together, you will get the risk adjusted discount rate. Okay, so then you have to discount the cash flows using this adjusted discount rate and arrive at the NPV. So by using this rate, if NPV is positive, you can go ahead with the project, otherwise you have to reject the project.